If you run a small or mid-sized business and you've ever thought, we need capital, but I don't want to make a mistake. Today's episode is for you. We're talking about the big fork in the road. Debt financing versus equity financing. Loans, lines of credit, revenue-based funding, SBA loans, investors, angel money, venture capital, even some hybrid options that sit in the middle.
And we're not just doing a glossary. We're going to get into the nuance, what each option really costs, what it demands from you, how it can help or hurt cash flow, and how to decide what fits your business instead of what sounds good in theory.
One quick framing before we dive in. Think of financing as two questions. 1, how much control are you willing to share? 2, how predictable can your cash flow be while you repay it? Debt usually keeps control with you but requires predictable repayment. Equity often reduces repayment pressure, but shares ownership and decision-making.
Also, cheapest isn't always the best. A low-interest loan that forces you to starve marketing for 6 months can be more expensive than a pricier product that keeps you alive and growing. The right answer is the one that survives reality.
Let's start with debt. Debt is borrowed money you must pay back, usually with interest, usually on a schedule. The core benefit is you keep ownership. The core downside is the bill arrives whether sales are up or down.
And debt comes in a bunch of flavors. The most common for SMBs: term loans, lines of credit, SBA loans, equipment financing, invoice factoring, merchant cash advances, and newer options like revenue-based financing.
Term loans are the classic. Here's a chunk of money. Pay it back over 3 to 7 years kind of deal. Great for something with clear return, like opening a second location, buy an expensive piece of equipment, or funding a specific build-out.
The trap with term loans is taking one just because it's available. If you don't know exactly what the money is for and when it pays you back, you end up with fixed payments and no extra cash to make them.
Lines of credit are different. They're more like a flexible borrowing bucket. You draw what you need, pay interest on what you use, and ideally you're using it to smooth working capital. Payroll timing, inventory cycles, seasonal dips.
A line of credit can be a lifesaver for a healthy business with lumpy cash flow. But if you're using it as permanent capital, you can get stuck. It's supposed to be a bridge, not the foundation.
SBA loans deserve special mention. These are loans backed by the Small Business Administration, often with longer terms and potentially better rates, but a heavier process. Lots of documentation, underwriting, and patience required.
SBA can be fantastic for acquisitions, real estate, or big expansion moves, but it's not usually your I need money next week option.
Equipment financing can be very clean. The equipment is often the collateral, and the loan term may align with the useful life of what you're buying. If that asset helps you produce revenue, the match can be neat and predictable.
Then you have receivables-based tools. Factoring and invoice financing let you get cash against invoices you've already earned but haven't collected yet. That can help businesses with big customers who pay slowly.
The big caution is cost and customer experience. Some factoring arrangements are expensive, and depending on structure, your customers might interact with a third party for payment. Not always a deal breaker, but it should be thought through.
Now the category a lot of people fall into when they're stuck: merchant cash advances. It's basically we'll give you money now and take a slice of daily sales. It's fast, it's easy to qualify for, and it can be brutally expensive.
If you hear daily repayment, and you already feel tight every morning checking your bank balance, that's your signal to slow down. Some businesses use it for short bursts when the margin is high and the turnaround is fast. But if it becomes a habit, it can trap cash flow.
Revenue-based financing is kind of a cousin that can be more reasonable in certain cases. You repay as a percentage of revenue until a cap is reached. The pro is the payment flexes with sales. The con is the total payback can still be high, and it works best when margins and revenue consistency are strong.
So what are the hidden costs of debt beyond the interest rate? One is collateral and guarantees. Many SMB loans require a personal guarantee. That means that the business can't pay. You may be on the hook personally.
Another is covenants and restrictions. Some lenders limit additional borrowing, require certain financial ratios, or ask for regular reporting. For a founder used to moving fast, that can feel like an invisible leash.
And then there's the simplest cost, Stress. Fixed payment are emotionally expensive when revenue is unpredictable. It can make you operate from fear, and fear is not where great decisions come from.
Okay, let's switch to equity. Equity is selling a piece of ownership in exchange for capital. You don't typically have required monthly repayments, but you're sharing future upside and sometimes giving investors a say in how the business is run.
Equity sounds attractive because it can feel like no payment, but the payment is real, just delayed and tied to the value you build. If your business becomes very valuable, that slice you sold can become extremely expensive capital.
Equity also comes in flavors. There's friends and family, angel investors, strategic investors, venture capital, and equity crowdfunding. Some are relationship-driven and flexible. Others are structured and very growth-focused.
Friends and family is common early on because people bet on you before the numbers are perfect. But it's also the kind of funding that can damage relationships if expectations aren't crystal clear.
If you take money from people close to you, treat it like a professional deal. Put terms in writing. Discuss what happens if the business fails. Talk about timelines. Turn awkward conversations into clear ones early, so they don't become painful later.
Angels are often experienced operators or professionals who invest smaller amounts, sometimes with mentorship. A good angel can open doors and help you avoid mistakes. A difficult one can create distraction if they want control without being involved in the work.
Strategic investors are interesting for SMBs. Think suppliers, larger companies in your space, or partners who invest because your growth benefits them. The upside is distribution, credibility, and operational help. The risk is you become dependent, or your strategy starts serving them more than you.
And venture capital. It's not better equity. It's a specific kind of equity. VC typically expects fast growth, a large market, and a path to a big exit. If you want to build a steady, profitable business and keep it for 20 years, VC may be a mismatch.
Exactly. A lot of small businesses hear about VC and think it's the gold standard. But VC is fuel for a certain engine. If your business model isn't that engine, the fuel can blow up the whole machine.
Equity crowdfunding is another path, where many people invest smaller amounts. It can double as marketing and community building. But it adds complexity. Lots of shareholders, communication demands, and a public story you need to keep consistent.
Now, the big hidden costs of equity. Control is one. Even minority investors can influence decisions through board seats, voting rights, protective provisions, or simply the pressure of expectations.
Time is another. Raising equity is a process. Pitching meetings diligence, negotiating terms. It can become a second full-time job, right, when your business actually needs you running it.
And don't forget misalignment. If you want stability and your investors want hypergrowth, you'll feel it in pricing decisions, hiring pace, spending, and risk tolerance. Money with the wrong incentives is expensive money.
So how do you assess what's right? Let's make it practical. We'll walk through a few decision lenses.
Lens number 1. Predictability of cash flow. If your business has recurring revenue, stable margins, and low volatility, debt can be a strong fit because you can plan. If revenue is uncertain or seasonal and you don't have reserves, fixed debt payments can be dangerous.
Lens 2. What the money is for. Debt is generally better when you're funding something with a measurable return. Equipment, inventory that turns, a marketing channel with proven ROI, an acquisition with known cash flow.
Equity is often better when you're funding uncertainty. New product development, a big pivot, entering a new market, or scaling before the model is fully proven. If you're experimenting, it's hard to promise repayment on a schedule.
Lens 3. Time horizon. If you're building a lifestyle business or a generational business, equity may be less attractive because you're giving away future distributions and control. If you're aiming for a high-growth outcome in a future sale, equity can make sense because everyone's aligned around that exit.
Lens 4. Cost of capital in real terms. For debt, don't just ask the interest rate. Ask the April, fees, prepayment penalties, collateral requirements, and whether the rate is fixed or variable.
For equity, don't just ask how much ownership. Ask what rights come with it. Who decides what happens if you want to sell later. Are there liquidation preferences? Are there investor vetoes on key actions like hiring executives or taking on more debt?
And here's a simple gut check question. If your business does amazingly well in 5 years, will you regret this deal? That question is especially revealing for equity.
Lens 5, your personal risk tolerance. Debt can put your personal finances at risk if you sign guarantees. Equity can protect you from that, but introduces partnership risk. You're tied to people and expectations.
Lens 6, your operational discipline. Debt often forces structure, budgeting, reporting, forecasting. That can be good. But if you're not already doing basic financial management, debt will expose that quickly.
Let's talk about hybrid approaches, because real life is rarely pure debt or pure equity.
One hybrid is mezzanine financing or subordinated debt. It sits between senior bank debt and equity. It's usually more expensive than a bank loan, but it can help when you need additional capital and don't want to sell more ownership.
Then there are convertible notes and safes, which are common in startups but can show up in growth stage SMBs too. The investor gives money now and it converts to equity later under certain conditions. It can speed up fundraising, but it can also create confusion if you don't model what conversion means for ownership.
And there's seller financing in acquisitions. If you're buying a business, sometimes the seller carries part of the price as a note. That can reduce the cash you need upfront, and it signals the seller has confidence the business will continue performing.
Now, examples. Let's make this tangible. Say you own a service business, like a digital agency, with stable contracts and predictable monthly retainers. You might use a line of credit to manage hiring ahead of revenue or smooth collections. Equity might be unnecessary unless you're trying to acquire another agency or build a product off the side.
Or take a retail business with seasonal spikes. A short-term inventory loan or line of credit can make sense if you know the sell-through is reliable. Equity could make sense if you're doing a major expansion into new locations and you want a patient partner, but you'll need to be clear about governance and exit expectations.
If you run a manufacturing business and you need a machine that increases capacity, equipment financing is often the cleanest. You're matching an asset with a loan. If the machine produces more output that sells, the loan pays for itself.
And for a high-growth software company with uncertain payback periods but huge upside, equity is usually more realistic early on because you're spending ahead of profit to grow. Debt can come later when revenue becomes predictable, like a venture debt or a line of credit once you've got stable recurring revenue.
Let's do a quick checklist a listener can actually use this week. If you're considering debt, ask, what's the exact use of funds? Will it generate cash fast enough to cover payments with cushion? Do I have at least a few months of runway? If revenue dips, am I signing a personal guarantee? And can I live with that risk?
Also ask, what's the total cost including fees? Is the rate variable? What security is required? And what are the consequences if I breach covenants? You don't want to discover that during a bad quarter.
If you're considering equity, ask, why does this investor want to invest? What outcome are they targeting? How do decisions get made? What happens if we disagree? And what does my cap table look like after this round and the next one?
And ask yourself, am I taking equity because it's right for the business, or because I'm avoiding the discipline of repayment? Sometimes people choose equity to avoid fixing cash flow issues, and that's a red flag. Equity doesn't cure a leaky bucket.
And the flip side, am I choosing debt because I'm afraid of sharing control, even though cash flow can't support payments? That's also a red flag. Pride is not a cash flow strategy.
Here's a practical decision tool. Write down 3 scenarios for the next 12 to 18 months. Base case, downside case, and upside case. In the downside case, can you still make the debt payment without gutting the business? If not, debt might be too risky, or you need smaller debt, longer terms, or a different structure.
For equity, run the opposite exercise. In the upside case, how much value are you giving away? If your upside scenario makes you win to the ownership you're selling, you might prefer debt, or you might raise less equity and combine it with a credit facility later.
Let's also talk about something founders forget. You don't have to choose one forever. Many healthy businesses use a blend over time. Early on you might use a small equity injection to build capacity, Then switch to debt when the engine is consistent. Or you bootstrap, then use a line of credit to scale, then bring in a strategic investor for a major expansion.
And a final point, the best financing option is the one you can actually qualify for on reasonable terms. So part of choosing is improving your readiness, clean bookkeeping, clear financial statements, a documented use of funds, and a real forecast. Those increase your options and lower your cost.
If you remember one phrase from today, let it be this: match the money to the mission and the cash flow. Don't force your business into a financing structure that doesn't fit how you actually earn and spend.
So, debt versus equity. Debt is a commitment. Equity is a partnership. Both can be powerful. Both can go wrong. The goal isn't to win an argument about which is better. The goal is to build a business that can fund its next step without breaking the thing you're trying to grow.
If you're making this decision soon, a great next move is to write down your top 3 funding options and list, for each one, the cash impact month by month, the control impact, and the worst-case consequence. The spreadsheet doesn't make the decision for you, but it stops you from guessing.
That's it for today. Next time, we can go deeper on how to prepare for a lender or an investor meeting, the documents you'll need, and the questions they're really asking when they say, "Walk me through your numbers."
And if you're listening and thinking, "I'm not even sure what I qualify for," that's normal. Start with clarity: where the money goes, how it returns, and what you can safely commit to. The right capital feels less like a lottery ticket and more like a tool.